In this new segment of Advisor Revelations, the DPL team will discuss how to evaluate new solutions and address current challenges and the strategies that can help you grow your firm and AUM.
Hey everyone, welcome to the Advisor Revelations podcast. I'm Willie, a consultant here at DPL, and today Scott, who's also a DPL consultant, is joining the podcast. We will discuss the sequence of return risk and other risk factors that may try to sneak into a client's portfolio, especially in this uncertain and volatile times in the marketplace. We're going to help you bring strategies you can use to bring your clients peace of mind. Welcome, Scott.
Thanks for having me, Willie.
Awesome. Before we jump in our conversation, I just want to remind our listeners that you can catch up on other episodes in this podcast. Just be sure to subscribe to your favorite streaming app for updates. And we have another resource and ways to connect with our team at dplfp.com as well. So, Scott, we've been having a lot of conversations now. We're kind of leading our direct-to-consumer client direct division, and we get a lot of calls in. It seems like a lot of clients are really worried about advisor terms, the sequence of return risk. Is that what you're seeing also?
Yeah, absolutely. Those crucial years, 5 years before leading up to retirement, 5 years after retirement, it's really crucial in a client's portfolio to make sure that their money's managed correctly from a risk standpoint, just because those years are so crucial for the longevity of their actual plan.
Totally agree. And right now we're actually dealing this even from 2020 with COVID and the market correction there. And now with all the volatility going on and inflation rising, we're getting a lot more phone calls for clients trying to flee to some safety and protection, which might not be the right thing to sit their money in cash right now, is it?
No, it's definitely not. I don't know of a good CD right now or rate, but money sitting in the bank's really not doing a lot for clients. I think the goal's to keep them invested and to get them to invest even more just because of the upside. I want their money to be working for them to keep up with inflation. I mean, there's so many different things that money sitting in cash, can really hinder a client's plan. Inflation, I mean, you name it. And I don't know of a good bank offering, 0.0 nothing on a CD or a savings account right now is probably not going to do the job.
You are correct. And as we talk about this, I'm talking to advisors also. They normally have that portfolio for their client getting ready to retire, maybe in a 60-40 allocation, and they're trying to use bond yields because when the market goes down, normally bond yields go up. But guess what? Interest rates are rising too, and bond yields aren't getting what they need either. Is that what you're running into?
Yeah, I'm seeing that a lot. So they're trying to advisors in particular are trying to, find other assets that can really create that return driver from a safety perspective, because they still want that fixed income allocation piece of the portfolio to provide that stability for that sequence of returns risk, right? I mean, they don't want to lose principal, but they also, on the other side, is advisors are charging fees on all those assets in a declining yield perspective. Like advisors and client portfolios, they're just losing a lot of money right now. And I've even seen some advisors choose to not charge an AUM fee or an advisory fee on fixed income because of the yields that they're currently seeing.
Yeah, and I really think that's a driver for clients to also want to find better places in a fleet of safety also. I mean, I'm working with specific clients right now that know they can't be in cash because inflation's rising, but they also are trying to look around to several banks to buy CDs, and the yield just isn't there either. So we really are trying to work with them to pivot to different solutions on annuities that are really fixed index and using them in a different manner. Mm-hmm. Have you been able to see that also?
Yeah, absolutely. I've got a few firms that I work with in particular that are really taking at least 25 to 50% of a client's fixed income allocation and allocating towards something like a fixed index annuity. Reason being, they're still going to get that stability that they would find in fixed income, but they change that return driver from the yields that they're currently seeing that are at historic lows to something that they're more familiar with, like an S&P 500 index, and the ability to take out the downside risk of that S&P 500 index and get a good amount of the upside is extremely attractive to clients. And it's a great way to, one, keep up with inflation and hedge for that sequence of returns risk in order to, keep clients where they're at.
Great. Scott, I totally agree with you. That's what I've been working with a lot of advisors on too. But I do get a lot of independent clients calling in looking for what we kind of mentioned earlier, those CD alternatives, because they know they're in retirement and they're like, I can't keep drawing down my portfolio. I need to even out this rides of these ups and downs. I need some safety and protection, but yet I also need yield. One of the things I know that I've been talking to them about are multi-year guaranteed annuities. And I'm just kind of laying that out for them and saying, hey, these are really alternatives to CDs are going to get you better returns. Are you experiencing that too? Or like kind of what are you sharing when clients are calling?
Yeah, I'm definitely seeing that for sure. I think safety of principal and something to keep up with inflation is important to clients. And with the rising interest rate environment, I think we're seeing a lot higher returns on these multi-year guaranteed annuities. So we're able to get a guaranteed rate for these clients and just make sure that they have peace of mind, that they know exactly what they're going to get when the functionality is exactly like a CD, something that they're familiar with, right?
Yeah, one of the things I'm running into as I talk to advisors about this is really repositioning annuities to not just think about income or just doing an exchange from a client that has an existing annuity, but to actually look at this as a risk management strategy to offset that sequence of return risk. You kind of touched on it earlier when you're talking about taking part of that fixed income allocation and moving it over. How has that been going with some of your advisors?
Yeah, they've really appreciated the analysis and building these types of annuities, the fixed index annuities into the client's plans. They've really appreciated the, due diligence of it and the actual return from a client perspective. Clients really appreciate the alternative solution and the fact that the advisor can get paid the same way and we can get a little bit higher return in a client's portfolio while still leaving, other assets in equities and fixed income in order to be able to rebalance in the portfolio. But thinking about it holistically as a piece of the portfolio has really been a cognitive just change in a lot of my advisors' minds because, looking back, I think a lot of advisors have looked at a portfolio, maybe like a $2 million portfolio with a client that it's a 60-40 allocation, but then they have a $200,000 annuity or something on the sidelines and they don't include that in the portfolio.
Yeah.
But it's important to include everything so that you know exactly what the client's going to get and how we maximize, equities, fixed income, and a fixed index annuity to help generate those returns and hedge for sequence of returns risk.
Totally agree with you. I keep telling my advisors, they look at the psychology of the client. Believe it or not, some of your clients like that safety and stability. It's not always going about trying to get equities and get super yield. If you can put them somewhere safe and get a 4% return, most clients are happy with that because that's what we're getting when we get these clients calling directly to DPL looking. That's what they're looking for, that sweet spot for safety principle and getting like a 4% return. They're really ecstatic. One thing I did notice with a lot of my advisors when I talk about using that FII strategy, because we get pushback every now and then, is telling them, look, this is not, your granddaddy's annuities. Things have really changed, and we have to really stress what a commission annuity or commission-free annuity looks like compared to a commission annuity. And one of the things I tell them is, on some of our solutions, you're forgetting about that 10% free withdrawal. What that allow you to do is you can reallocate a balance to your portfolio. So if you're getting great yields on the fixed income side, when there's a buying opportunity, you can pivot to the equities and take some of those funds out to reallocate it and buy when equities are on sale, just like now. Have you thought about, sharing that with them, or what have you seen them do?
Yeah, I've shared that a lot because I think it really drives the point home that the fixed index annuity, while one, you're diversifying away from historic lows in fixed income, is really the same functionality as the fixed income that you're looking for. So when there's a buying opportunity, you can take that 10% free withdrawal from the annuity, penalty free, not pay any interest rate risk like you would on a bond, and get into the market when there's a good buying opportunity. It's more flexible from that standpoint as well to rebalance within the portfolio to buy at lows and sell at highs. It's got so much more flexibility than a normal bond would too.
Yeah, exactly. And that's what we're all talking about here around the sequence of return risk. These clients are entering into retirement. If the market keeps doing what it's doing, you're going to have a bad couple of years for these clients. So we really need to get advisors to kind of open up their minds and know that they can pivot and have awesome strategies while working with us. Scott, one of the things we are focusing on still is that sequence of return risk. What about clients that, they're really going to cash because they're scared? Let's be honest. They're worried about the future. It's more about a theory of asset management versus asset location. What are you sharing with your advisors there to help them kind of get over those hurdles?
I think the main thing to consider with the advisors and really with the client is to talk with the client and figure out, 20 years from now into retirement, are we going to be worried about what our portfolio return is looking like? And if we are, we're probably going to want some sort of guaranteed income stream, some sort of pension-like guaranteed income stream, because we're not going to want to risk the income on what the portfolio does in the market. So for those clients that are very bullish on the market, it probably doesn't make sense for them, right? But for those clients that are scared of what the market's going to look like over the next 5, 10, 15, 20 years, and at some point they may want to settle into cash, that's going to really reduce their ability to succeed in retirement. So they're probably going to want that sort of peace of mind and guaranteed income. I think it's more about figuring out what's important to each different client, because each client's different.
I mean, I totally agree. I tell my advisors, once again, psychology of the client, understand what's most important to them, because once you satisfy that need, it also allow you to pivot when you can to be more aggressive when there is a buying opportunity in the market, because you can look at them and say, hey, Mrs. Jones, we still got all your base expenses taken care of. You said that was okay. So no matter really what the performance of the market's doing, you're going to be all right. And I think there's really something in a client having that peace of mind. Would you agree?
Yeah, absolutely. Because I think you got to consider with the client, are they staying invested right now? Or are they still invested in the market? And will they have the stomach to stay invested long term? Because not staying invested is what can really derail a client's portfolio. So if they're going to get scared of the market returns later on in their retirement, maybe we do need to guarantee their income and take the income risk off the table so that we know we can be aggressive with the rest of the portfolio and stay invested in the market so that there's additional assets for discretionary expenses, legacy purposes, etc. Just allows a lot of peace of mind for those clients that really are going to be scared of the market, and it's better for their overall plan to keep them invested.
Yeah, totally agree. Once again, it's that 5 years before and that 5 years after they can really set up their whole retirement, and whether they're worried and have to go back to work or they can vacation in Tahiti.
Exactly. And who doesn't want to be vacationing in Tahiti at retirement?
True. Scott, I know I talked about it a couple of times, the psychology of the client. The great thing about it is that Wade Fowle and Alex Murguia, they've actually created a tool that's going to be available for DPL members to utilize on a trial basis to see exactly how that works. And it's called the RISA. It's a retirement income style analysis that you can use for your clients. And it basically will let you know what your client thinks is most important to them in 4 separate quadrants, whether that is safety and principal, or hey, they want to be all in for market forces. And this will really help you plan for your clients and not use the same cookie cutter approach for every client portfolio that you're managing, but really get down to the nuts and bolts of how can I manage this to give that client peace of mind.
Yeah, I think that's a great tool, Willie. Just for any advisors out there, member firms of ours, reach out to your individual member consultants or your internal consultant, the team that you work with most on a day-to-day basis, and they'll be able to get you set up on our pilot program. We'll get it set up for a webinar so you can have access to the tool, and you should be able to find more information on our website as well.
Well, Scott, I just want to thank you for your time today, and I want to thank our listeners for joining. Again, to keep this conversation going, just go to our website, dplfp.com, to the Meet the Team page to connect, and there are other resources there available as well. So, Scott, I guess we'll connect next time. Have a great one.
Looking forward to it. Thanks again, Willie.
Thanks for listening. To hear more advisor revelations, go to dplfp.com and subscribe on your favorite podcast streaming app.